That's right, Tyler. So you actually hit on it in that conversation a moment ago with Bob Bazzani. If you look at the market now, it feels much worse than it actually is. And if you look back at the year and certainly the gains off of the pandemic low in March of 2020, we have come a very long way. A lot of people have a lot of profit. But when you think about how to invest for the long term, it's been proven for really almost two entire generations that when the market trades off somewhere between 10 and 20%, which really are normal corrections in the course of bull markets, which we think this is what this is, you're paid to be a buyer of that. You're paid to sort of put your emotions to the side and do what you know to be correct, which is buy low. And so what we're telling people is you have to really gut check and know yourself. And if you don't see yourself being a buyer into that kind of weakness, chances are you own a little bit too much stock here, and you should trim to get to the point where you do see yourself.
Yeah, so always think back. I think it's wise you think back to March of 2020 when the market was doing this in response to COVID. The people who have done the best since then were the people who put money in then, not the people who bought 6 months later, a year later, or what have you. Let me talk, I want to hear you talk a little bit about the art of trimming your portfolio. Where, if you are nervous right now, you're close to retirement, you don't want to see your money go down 20%, how and which areas of your portfolio should you look at to trim, and by how much?
So the first thing we'd say is this, is that a lot of the talk about cash being trash, there is always a time, it may be very temporary, where cash is not that way. And in fact, if you think about it, building a little bit of cash supports the idea, the possibility of buying lower. From our point of view, what's different about this cycle right now is that we've had this sharp drop off in consumer sentiment. At the same time, we've seen savings, albeit elevated, run down. That combination has in the past led to consumer discretionary stocks underperformance. And when you look at it, there's a lot of consumer discretionary stocks that have really, really worked well off of that March low. That's an area where we think you might be wise to trim. Conversely, when you look at places like healthcare and consumer staples, those are more attractive, more resilient into the kind of volatility and potential, continuation of politics and geopolitics that we've seen. So there's no magic bullet on how much you should trim. Obviously you can get advice from your financial planner in terms of what your age is, but in essence, it's a question of your comfort level and your investing horizon. And part of the beauty of this bull market for the last year and a half is that we brought in a lot more investors who have 30 and 40-year time horizons, which to us bolsters the long-term case. X of our 4,000 year-end price target, it bolsters the long-term case for equities moving higher.
Shepard Smith here. Thanks for watching CNBC on YouTube.